Hello and welcome to this very special EU referendum broadcast. I'm Ben Traynor, editor of the Daily Reckoning, and I'll be your host. I'm very fortunate to be joined by two currency wars heavyweights. I've got Jim Rickards, who is author of the book Currency Wars and also wrote The Death of Money and most recently, The New Case for Gold. Jim, welcome.
Ben, thank you. It's great to be with you. I can't think of a more exciting and urgent time in the currency world and not a more important time to be here in the UK, so I'm thrilled to be with you.
I'm also joined by currency trader Tom Tragett. Tom is what you might call a veteran of the currency trading arena. Tom, you've been doing this for 37 years, is that right?
Yeah, that's correct, almost as long as I can remember. Thank you, Ben, and it's great to be here too, echoing Jim's sentiments. It's really fantastic, exciting time we're facing here with potentially once in 50-year cycle move here in currencies.
Now, over the course of this broadcast, we're going to be walking you through the implications of the referendum. We're going to be walking you through what the implications are if the vote is to leave. We're also going to be looking at the implications of a vote to remain. We're going to be focusing not too much on the politics, which you probably had your fill of that. We will be focusing on the impact on financial markets, on the UK economy, and most importantly of all, what you can do about it and how you could potentially trade this event for considerable profit. We've gathered a lot of reader questions about this, as you can imagine. It's a very, very big event. One might say the only event at the moment. We will be answering those towards the end of the broadcast, so do make sure you stick around. And I'd like to start by asking you, well, what implications do you think there have been so far from us having this vote?
Well, primarily, leaving the politics aside, the pound has been under a degree of pressure. We've seen sterling drop through 140 earlier in the year after the Brexit referendum was announced. It's subsequently been back up to 147. It's been ebbing and flowing with every sort of poll that's come out. We've also seen that sort of uncertainty in the pound spread actually to wider markets. We've seen hesitation from the Fed as a result. There's no doubt in my mind that the Fed probably would have raised rates in June or certainly in May had it not been for this looming decision. That uncertainty has, as I say, has ebbed and flowed with every poll that's come out. It was looking at one point as if the bookmakers here were saying, it's 80-20 that we're going to stay in Europe. And in the last couple of weeks, that has shifted slightly towards maybe 60-40, and it's looking very much like it's probably going to head towards around 50-50 come the night of the vote itself, or the day of the vote. Now, implication-wise for sterling, my view, and I've expressed this before, is that if we do vote to leave, then the pound will suffer a significant drop. I think if we vote to stay, it could rebound a bit, but I'm, again, not looking for that much of a rebound because I think the UK economy is structurally quite weak anyway. Couple that.
So you think any rebound will be temporary?
Yes, I think there's a chance that we could move back to, say, 150 against the dollar, maybe 160, but I'm not looking much beyond those sort of
And that's
levels.
in the event that we vote to stay in the EU?
Yeah.
What could happen if it goes the other way?
Well, there's a lot of stuff to cover there. We'll look at the technical side of that in a second, I guess, but I think it could fall significantly through 135 towards 125 initially, and perhaps even towards parity to the dollar over a longer time frame.
And explain what parity means.
That's 1-to-1, dollar sterling 1-to-1.
So how big a move is that from where we are now?
Well, we'll be looking at about a 30% move.
30% move.
Yeah.
And so for those people watching tonight who trade Forex, how many points is that? How many pips?
Well, initially, we've assumed the current rate around sort of 142, 143. We're looking at probably potentially 2,000 or 3,000 pips initially.
2,000 or 3,000
initially, yeah.
So potentially a 2,000 to 3,000 point move. That's a large move.
Well, as I said, it could actually be bigger than that. But the reasons me and Jim were discussing earlier was the scary thing about what's happening with the banks and how they may be turning their pricing off.
We'll
cover that.
We'll get to that in a moment.
Yeah,
We're going to be answering questions that readers have sent in this evening as well, and we're going to be getting to them at the end. And I think some of them will be covering that. But Jim, what would you say would be the international implications if the UK were to vote to leave the EU?
Oh, that's a great question, Ben. And it's really what is characteristic of global markets today is the degree of interconnectedness. I call it a density function. That's a scientific term. In international monetary jargon, you hear phrases like contagion and spillover. These are not just metaphors. They're actually describing dynamics from different realms. Contagion obviously is, having to do with medicine and epidemics, and spillovers is, kind of a physical dynamic. But it does play into markets, and there are many, many examples of it. I'll give you just a few. In August 11, 2015, China did a shock devaluation of the Chinese yuan. They lowered the yuan 3% against the dollar overnight. That's a huge move, as Tom knows. Usually currency trading, you're talking about, you're out to 5 decimal places, and that's the bid offer. Here was 3% overnight. This caused massive capital outflows from China. The U.S. stock market sank like a stone. By late August, we thought we were staring into the abyss. And the Fed was sort of on course to raise interest rates in September 2015. That would have been the liftoff. As you know, they ultimately did raise them in December 2015, so-called liftoff, first rate increase in 9 years or over 9 years. But they were planning to do it in September. They didn't do that. They started happy talk and easing and kind of, got the markets to come back a little bit. So it wasn't the end of the world, but it was from August 11th to August 31st. It was a very scary 20-day period. And people said, wait a second, what does the Chinese devaluation have to do with U.S. stock markets? But it was a perfect illustration of how they're all connected. When people are fearful here, they want liquidity over here. You don't sell what you want, you sell what you can. U.S. stocks were liquid. It was a way for people to get cash. Another example, I happened to be in Tokyo in September 2007, at the very beginning of the last global financial panic. And at that time, of course, that was a year before Lehman and AIG. That all came to a head in September, October 2008. But that crisis started in the summer of 2007. I was in Japan in September, and their stock market was going down, and my Japanese friends turned to me and said, Jim, we understand that you Americans have a mortgage problem, but we don't understand what that has to do with Japanese stocks. And I said, well, what's going on is that hedge funds have mortgages. They would love to dump the mortgages. They can't. They're sinking like a stone. They're getting margin calls. So they're selling other things because they're liquid. So they're selling Japanese stocks to get cash, to meet margin calls on mortgage positions that they cannot sell. So again, just an example of the interconnectedness. And what's I gave you 2 examples, China, U.S., and Japan, U.S., but the point is it's unpredictable. You can say there's definitely a shock coming somewhere. Brexit is a perfect example. We don't know what the outcome is going to be. It's really too close to call. As Tom said, we're doing the economics and the risk factors of it, not the politics. We leave that to the voters. But the fact is, you can see where the shock is going to come, but what you don't know is where the effect is going to be. It could be in the United States, it could be in Asia, it could be Japan, and then it feeds on itself. That's where the feedback loop kicks in. That's where the contagion effect kicks in, and you don't know where it's going to end. And when people are in that situation, they just run for the exits. They dump everything, get cash. They do go to gold. Gold is one of the safe havens. I think it's pretty well known. Cash is another one. But this has potential not just to shock UK markets, and Europe, but really the entire world.
So the ground zero for this, will most likely be the pound sterling. Would you agree, Jim?
Well, we'll certainly start there, and I agree with Tom. If the UK voters vote to leave the EU, you would expect a drop down of sterling immediately. But the problem is, above all, markets can absorb any kind of news in time. What they hate most of all is uncertainty. So that's exactly the situation you have today. If the polls were showing very heavily in favor of remain, markets would have priced that in already. If they were very heavily in favor of leave, markets would have priced that in. But the fact is, the polls are closed, the betting is closed. So the markets have kind of priced half the outcome, which means that you automatically have to reprice the other half instantaneously once the result is announced. So if the vote is to remain, there might be a quick relief rally. If the vote is to leave, there might be another leg down. But either way, you're going to get a move, and you don't know where that ends.
When the markets open on Friday morning, potentially things could start moving very quickly indeed.
Well, Tom made the point that it could be before that. Now, your polls close at 10 o'clock, 10 p.m. So the UK markets will be closed. The US markets will be just closed. But who knows if there's exit polling or other research means to get wind of this, and market makers may back away. Of course, today, you do have regular market hours for stock markets, but there's after-hours trading, 24-hour commodity trading, 24-hour currency trading. The U.S. may be closing down, but Asia will be opening up. So I don't necessarily think we're going to get a night off. There's going to be an immediate impact. It'll start in Japan and spread around the world. So by the time UK investors wake up Friday morning, you will already have seen some shock effects in Asia.
Now, Tom, you started to touch on this before, but I know you've been, when we've been speaking, the fact that this event is looming so large and is such a big international event, as we've just heard from Jim, that is already starting to have an impact on markets and on the liquidity that traders are finding, or rather the liquidity that they're finding isn't there. Can you elaborate on that?
Well, yeah, it's drying up, in effect. Well, not in effect, it is drying up. And that's led to some quite sharp moves. You can see on the price action, most of the people probably looking at this video here today are probably not aware of actually the dynamics of how the market functions, in its minutiae. But what I can tell you is that moves that would normally be 30 or 40 point moves are now suddenly 100 points or 150 points. So we're seeing a widening of the daily range. Sometimes, like last week, we had 200-300 point moves in cable just on one poll. So that tells you that there's very little liquidity out there. There's very little volunteering of any pricing. People are only putting in stuff into the market that they need to do. So nobody's going to volunteer a price for somebody else's benefit. Now that's only going to get worse come, as we get closer to knowing the actual outcome of this poll or this referendum. And that, of course, is going to take place, we assume, around sometime between 10 o'clock and first exit polls. Could be before then, as we said, but it's happening at a time when liquidity is bad anyway on that US-Asian handover, when, in the middle of the night when there's not good liquidity around at the best of times. So,
and these are not the best of times.
No. So this could be exacerbated for that reason alone. And then what we have heard is that a lot of banks are not going to volunteer prices. So, there's no open outcry anymore.
When you say not going to volunteer prices, what does that mean?
They're basically not going to put any pricing into the system.
They're just not going to quote anything?
No. Why would they? Why would you? Unless you have to, why would you?
Now, Tom makes a point about this drying up of liquidity ahead of the result of Brexit, and he's exactly right. But there's a broader point. Liquidity has been drying up anyway, ever since 2008, for a variety of reasons. In the U.S., we have the so-called Volcker Rule, which has forced banks out of certain risk-taking activities. We have Basel III, which has increased capital requirements. And banks have said, well, look, with this amount of capital, this is just not a profitable business for us, so they're getting out of that. So one by one, liquidity is starting to disappear from these markets, even the Treasury market. People scarcely say, Treasury market without saying the deepest, most liquid market in the world. Well, it is the deepest, most liquid market in the world, but it's not that deep and it's not that liquid. And I've been in the U.S. government bond business for 30 years, and I still talk to a lot of people on trading desks, strategists, rate strategists, and so forth. And they say, Jim, trades that we used to do in seconds, and not automated, we do them in the phone, back in the day, but you can move 100 million, 200 million just like that. And now they might have to work that order over minutes or hours. If it's in treasuries, if it's in corporate bonds, forget it, it's almost by appointment. So there's been a long, persistent trend in the drying up of liquidity anyway. Now you take something like Brexit, put that on top, and as Tom says, it's going to the point where there's no liquidity, no bid, no offer. We'll get back to you when we feel like it. And so if markets break, there'll literally be no bottom.
So the implication is that we could, by the end of this week, be seeing moves that you just generally don't see, very, very large moves.
Well, yeah, exactly that. And the other fact that we need to point out here is that open outcry in terms of foreign exchange is virtually gone. Mm-hmm. Except in the peripheral satellite currencies, some of those. In terms of your dollars, your sterling, your euro, yen, everything's algo-based, it's on computers, and it's robot-based, if you like. So once you turn those machines off, there's no price.
Right.
And that's it. It's like, where is it? and it will go wherever, like water, wherever it wants to.
So Tom, people who are watching at home who trade markets, what can they do about this?
Well, primarily they should be looking at this as an opportunity. In fact, probably a once in a 25 or 50-year opportunity, specifically towards the pound. Now, a lot of people would say that this is a negative potential outcome, but if we do decide to leave Europe, but I actually look at that again as an opportunity from a trading perspective, because there's going to be some big moves. And you know, from my side of what I'm trying to do is to guide my clients and readers through the best way to attack the markets and to take a positive, proactive approach to the moves that I think are going to unfold, and guide those guys through and how they can make a profit.
These are the kind of big moves that you look for
Yeah,
on currency
absolutely.
wars.
I mean, this, as we said, look, this is potentially a once in a 25, 50-year move. And you need to be aware of it. You need to be ready to take advantage of it. If you're trading the markets, you want to be on this move. You do not want to be left behind.
Now, because this is such a unique opportunity, we've actually reopened Tom's Currency Wars alert service for a very limited time. And we're also, because we want to get this information to you, we put together a special offer which offers you a very, very significant discount. And I'll get details of that to you very shortly later in this broadcast.
And I want to emphasize the importance of what Tom's doing with Currency Wars Alert, because it goes way beyond Thursday and Friday, way beyond this trade. Tom's exactly right about the shock to sterling. But, you know, some people say, well, fine, yeah, but, you know, I live in the UK, I make money in sterling, my expenses are in sterling, so there's a big shock in the currency. What does it have to do with me? Unless you're a day trader or a currency trader or someone looking to make a quick pop, how does it actually affect you? Well, the answer is it affects everybody, whether you know it or not. If you lower sterling, which is one of the implications of what we're talking about, by the way, I would take the view that sterling will go down quickly if the UK votes to leave, but it will go down anyway if the UK votes to remain for other reasons, having to do with the fact there's a hidden agenda here, which, you know, David Cameron hasn't really been candid in my view, which is if they vote to remain, that's a step towards the UK adopting the euro. It just doesn't make sense.
Adopting the euro?
Yes, it doesn't make sense for the UK to be in the EU and not have the euro. You could leave and keep sterling, or you could remain and go to the euro. And they're not talking, and I say they, I mean the International Monetary Elite, they're not talking candidly about the fact that this is all leading in the direction of going to the euro. Well, if you're going to have sterling enter the euro, just like all the other currencies, we have the French franc, the German Deutschmark, the Italian lira, etc. They all join the euro in different ways. If sterling is going to join the euro, it's very advantageous to have a low exchange rate. The lower the exchange rate, the more, you know, the more of a trading advantage you're going to have. When you fix sterling to euro, you want the lowest possible entry point. So sterling will get down quickly if the UK votes to leave. It will go down slowly if they vote to remain. But either way, it's going down. So there's an important trading opportunity there. But beyond that, even if you're not a day trader, the implication of a weaker currency is inflation. I've seen this around the world. I remember in my first book, Currency Wars, came out in 2011. This currency war has been going on since 2010. So when I started writing the book came out in 2011. Here we are 6 years on. It's still going strong. And one of the things I said is that the world is not always in a currency war, but when they are, they go on for 15 or 20 years. That's what history shows. So again, Tom's service is going to be valuable 5 years from now, 10 years from now, even though there's a particular opportunity this week. So I'll use Brazil as an example. In 2010, 2011, Brazil had one of the strongest currencies in the world. And they were the ones, it was Guido Montenegro, the Brazilian finance minister, who first used the word currency wars. That was actually the inspiration for the title of my book. But Brazil set out on a course of trying to weaken the Brazilian real. And they did it by cutting interest rates. And I watched that happen. I said, you know what, guys? You're not going to get the growth you want. You think you're weakening the currency to help Embraer sell a few more airplanes or help Rio tourism. You know, you're listening to your exporters and your tourist board and all that. They started cutting rates. They said, you're not going to get the economic growth you want. All you're going to get is inflation. 3 years later, they had a massive inflation problem. They spent 60 years getting inflation in a bottle, and then they let the genie out of the bottle. So then they had to raise rates to snuff out the inflation and put the economy into a recession. So now Brazil is a mess, and yet they were in very sound financial condition as recently as 2010. Now they've got a severe recession, very high inflation, rising unemployment. So even from the UK perspective, if you cheapen the pound, it affects everyone. It's not, you can't just say, well, I get paid in pounds, my expenses are in pounds, it doesn't affect me. You're going to get inflation in the UK. That has implications for property markets, which are already look like a bubble, gold, other assets, bonds, etc. So it goes way beyond just a cross rate for a couple of days. And that's really the value of what Tom's doing. Tom's going to stay on the story for months and years ahead.
Yeah, well, Tom, you've got one chart in particular that I know you've looked at, which shows the long-term picture of sterling. Can you describe that to me?
Yeah, it's basically, well, I've got it on two time frames. The one I think we showed to people before was on a 25-year time frame. And it's a head and shoulders pattern, which tracks basically the movement of the pound from sort of, 1980 to now. And, you look at this pattern and you see, a lot of it's involved in technical analysis, of course, but basically a break through the 135, 137 level argues for a significant move lower, way, way below parity to the dollar, and perhaps to as low as 63 cents.
63 cents to £1.
Now that's a technical study. I'm not saying that's necessarily that, we're going to wake up on Friday morning and sterling's at 63 cents. Not far from it. Don't forget, this is a 50-year chart, and it takes a long time, that move, to evolve. Now, in between then and now, there's going to be an awful lot of changes and things that are going to happen as a result if we do decide to leave. And as Jim said, that could be, the first thing that comes to my mind would be higher inflation, because the pound drops. If it drops significantly, there's going to be more upward pressure on prices. Now, that also does provide opportunity, but initially what it could do is force the Bank of England to raise rates for two reasons. Firstly, to protect the inflation rate. Secondly, because the value of the pound is falling, they have to try and defend the pound. And that will then have a serious knock-on effect onto the property market. And as Jim said, it's a bubble. It's been evolving for
this could be the
20
pin
years.
that pops
It could be the pin that just goes, one more weffer, bang. Of course, we could be sat here a couple of weeks' time and we've decided to stay. But as Jim says, and I agree, I still think the pound will go down.
And the world is a dangerous place with or without Brexit. Brexit makes it worse, but and it's only recently, it's kind of interesting that what I call the power elite, when I say that the international monetary power elite, it's not some deep, dark conspiracy. I mean, we know who they are. It's Christine Lagarde and Janet Yellen and Mario Draghi and Larry Summers and the people who show up at Davos and G20 meetings. I mean, they all have names and resumes, and they have websites, and they publish things. You have to be a little bit of a geek like me to read it, and even for those who read it, it's hard to understand. You need the kind of technical background that Tom and I have, and that's what we do for readers, is take that technical language, put it into plain English so people can understand. So, but they're out there, and they're talking about this. And I mentioned earlier this August 2015 shock devaluation of the Chinese yuan and the knock-on effect that had immediately in U.S. markets. But that happened again in December 2015, January 2016, where the Chinese devalued again. They were smart enough not to do it all at once. They were doing it in baby steps. But you could look at that pattern every day. The Chinese yuan was getting a little bit weaker, a little bit weaker. And then, of course, we all know what happened starting January 1st. The U.S. stock market fell out of bed again. Through February 11th, it was a full-blown correction, down over 10%, again because of capital flight from China and what was happening with the Chinese yuan. So come forward to February 26, 2016, Shanghai, China. The G20 finance ministers and central bankers are meeting, and what I call the G4, a group within a group. So that's the U.S., Europe, through the European Monetary Zone, Japan and China, four largest economic groups in the world, 2/3 of global GDP. They cooked up a plan. They said, look, China is slowing dangerously. They need relief. They need relief in the form of a cheaper currency. But the last two times that they devalued against the dollar, the U.S. stock market's almost collapsed. We were on the edge of global contagion, global meltdown, 2008, except bigger. So how do you give China relief without breaking the yuan-dollar peg? And they said the way you do it is keep the peg and cheapen the dollar. In other words, bring the dollar down. That way you can keep the peg, which everyone was looking at, and cheapen the dollar at the same time, and the peg's along for the ride. Well, who loses in that? Because that's the essence of currency wars. As you know, Tom, for every winner, there's a loser. It's a zero-sum game. Well, the answer is you had to have a stronger yen and a stronger euro. And this is the Shanghai Accord. And we talked about this in our U.S. publication at the time. And everyone's shocked. Well, gee, look at the Japanese yen. It's gone from 120 to 104 in no time, and looks like it's headed through 100, maybe even in the high 90s. It's a much stronger yen. Well, isn't Japan a mess? Doesn't Japan need a cheap currency? Of course it does, but you can't have it. That's the essence of currency wars. Not everybody can devalue against everybody else all at the same time. So if the U.S. and China are going to devalue, then the yen and the euro have to get stronger. And this is an example of how when you get the right currency war analysis, if you get one thing right, you can get a lot of other things right as well. And so here's sterling kind of on the periphery of this big four, not quite in the big four, but a very important economy and important currency, trying to weaken kind of along with the dollar and the maybe
it's against the grain of the others, isn't it?
Exactly. And so we tend to focus on cable, the sterling dollar cross rate, but sterling euro, I mean that's another very important battlefront, if you will, in the currency wars. But my point is, the world was deeply concerned about China and the U.S. China slowing, the U.S. looking with really punk growth, perhaps on the edge of recession, cooked up all this Shanghai Accord. This was all without regard to Brexit, because the elites thought that the UK would definitely vote to remain. They didn't really think leave was a possibility until very late in the game. And now they're like, wait a second, we got a global mess over here, and you've got another catalyst over here. This is like kids playing with dynamite, lighting matches and with boxes of dynamite lying around.
Well, I think that's interesting because that highlights to me exactly why we've had such dire warnings from the IMF, from the OECD, from the Fed, from US President, even Japanese Prime Minister has come over here and warned us about voting to leave the edifice. And the interesting thing for me is that these warnings come at a time when we've had the worst global recession for decades. But the recovery has been slow, it's been very gradual, it's been anemic at best. And what the authorities, the global elite, the financial elite, if you like to call them, Jim,
right,
what they don't want right now and what they're fearful of is this rabbit, that's going to jump through the bottom of the hat, and it's going to basically make everything a lot more difficult for their anemic policy response. It's going to force them into a policy response they haven't really got. That's what they're worried about. And that's the issue here. And that's why we've had such dire warnings from those guys.
And one thing we know that printing money doesn't work, negative interest rates don't work. They pulled every monetary rabbit out of the hat. Lower rates, zero rates, negative rates, QE1, QE2, QE3, currency wars, forward guidance, you name it. They've tried everything. It has not solved this problem. The problem keeps getting worse. Meanwhile, credit creation continues. The idea that the world is deleveraged is nonsense. There's a McKinsey study showed that we've added $60 trillion of new debt on top of all the debt we had in 2008.
Half of that central bank debt, I think.
Correct. Well, that's right, but the central banks are bigger, the commercial banks are bigger, they're more concentrated. Everything that was dangerous in 2008 is more dangerous today. So something like Brexit is a catalyst, but I agree with you completely, Tom. There probably will be very large losses for people who are not positioned correctly, but for every loss, there's an opportunity. There are opportunities to make huge gains. That's what you point out in Currency Wars Alert. And it's not a one-time thing. This is going to just echo and rattle around the world, like a pinball and a pinball machine. That's going to affect the yen, the euro, the yuan, Canada, stock markets around the world, UK markets. It's going to have many implications that are going to play out over months and years, and that's really the value of the service.
Absolutely.
So, Tom, what aside from sterling, then, given that this has the potential to rattle around the world, what other currency pairs are you particularly looking at?
Well, we've already seen how the yen has strengthened, as Jim said, against the grain, against the fundamentals. Sterling yen has been seeing some crazy moves even in the last sort of fortnight. Sort of 5-7% swings in very short order. So the yen is obviously high up on the list there of trading partners in terms of the pound. Obviously the dollar with that potential cable move. The euro, as Jim just pointed out. I mean, I would say you can't really leave anything off the list here. Yeah.
And I would add gold. I mean, this is not a gold newsletter. This is the Currency Wars.
Although I do know Tom looks at gold as well, don't you, Tom?
Well, gold priced in sterling, certainly. If contagion starts to spread and stock markets globally do take fright, then gold, as we've seen already in the last week, has moved up from sort of nearly 1,200 back above 13. That's like a 10% move in a week. You know, we haven't had anything happen yet.
Right.
So you can imagine what it could do if some of the things do evolve. So, but priced in sterling, it could be even bigger move.
But these currency pairs that you mentioned, these are all pairs that you're actively looking at right
Absolutely,
now, and there are potential trades which
Yeah.
you could be sending an alert out to people.
Well, the highlights there are obviously sterling dollar, euro sterling, euro yen, dollar yen, and obviously we would look at the Swiss, although I'm a bit loath to, after what happened in January 2015, to be involved in the Swiss. I don't think it's necessary. I think sterling, yen and dollar would be the focus there, and any combination of those with gold.
By the way, there's a sort of a 500-pound gorilla in the room that we're not talking about. We mentioned gold briefly, and as you say, Tom, I consider it a form of money more than a commodity or an investment even. So when I think of money, I think of dollars, sterling, euros, yen, and gold. It's just another currency and has a place in the currency wars alert. But I think the UK audience understand that the UK sold over half its gold between 1999 and 2001
Brown's
in
bottom.
a series of auctions organized by Gordon Brown at the lowest prices in 40 years, lowest prices in 40 years, around $200 an ounce, give or take. But as a result, you know how sterling with no gold. Look, the U.S., for all its faults, has 8,000 tons of gold. The European Monetary Zone, for all of its faults, has 10,000 tons of gold. If you combine all the members, Germany about 3,000, France 2,000, Italy 2,000, add it all up, they've got 10,000 tons. The U.S. has 8,000 tons. China is on its way to 5,000 or 6,000 tons. They're not transparent about it, but that's a reasonable estimate. But the UK has a couple hundred tons, a tiny little sliver for a major economy, one of the largest economies in the world. So if you vote leave, this is not a political statement, just economic analysis. All of a sudden, see, because as long as you're in the EU, you have kind of a soft call on the euro. If the UK got in distress, they could turn to Europe and say, okay, we're ready to join the euro, et cetera, which is why I brought that up earlier. But if you leave, now you've got the currency, you've got no gold, no significant amount of gold, you have no lifeline to Europe, you're really on your own. This pound is just sort of sitting there in thin air, ready to drop. That's a very dangerous state of affairs.
Well, traditionally, throughout my trading history, going back to the late 70s, which seems a long time ago now.
It was a long time ago.
Yeah, it was.
It's good experience, though.
Yeah, from what I can remember of it. The thing is, sterling is always subject to indigestion. There's always has the potential for a sterling crisis. We've seen a number of them over the years. And, clearly this current situation brewing, we're on the cusp of that. But I'm not worried about that because, as I said, I think that, if it moves, there's opportunity. And we need to be ready for that opportunity.
And if you want to get Tom's advice on an ongoing basis about how to trade, not just this opportunity, but other opportunities that will come along,
Sure.
given the big moves that we're seeing in the currency wars, then click on the link below. As I said earlier, we put together a very attractive offer, and you'll find more information by clicking on the link below.
As I said, the fascinating thing for me is to look at a 50-year chart of sterling evolving, potentially breaking to the downside, at the same time as we have the biggest geopolitical event this country's had over the same time span, 50 years.
And there's the absence of liquidity that we talked about earlier.
Well, exactly. But isn't it weird that the two are kind of tying in at exactly the same moment in time? It's fascinating to me.
And I don't know how people sleep at night without a service like Tom. Look, the politicians don't play straight. The bankers don't play straight. Where can you get independent economic analysis that will actually help you avoid losses in the first place and then make huge gains when these opportunities arise? So these kind of independent services are incredibly valuable.
Yeah, I think what tends to happen these days is that, people who have a service from a retail price provider, the retail price provider wants your business because they want you to trade with them. They want your money. There aren't many people offering what I would call valued independent advice, where there's no hidden agenda there.
You will show restraint where that is the best way to.
Well, where I would try and guide people in the same to do as I'm doing.
But you're not just encouraging people to trade for the sake of trading.
No, absolutely not. I would discourage that 100%. 100%.
I'm going to shift gears a little bit now, because we've spoken about some of the fallout we could see from voting to leave. Yet, despite the pain that we could see, Tom, that's where you are. That's the camp you're in. I mean, is that fair? Is that right?
Yeah, it is. I mean, I've like everyone else, I've given it a huge amount of thought. We've been bombarded in the media for several weeks now, and it hasn't finished yet. My view on this is quite simple. Leaving aside the economics or the politics, it's purely about sovereignty to me. And my view is that we didn't sign up for this in 1975. It has evolved. I think when there were 5 countries in Europe, if you were one of the 5 originals, you had a say. You had a determination in that. When there were 9, you had a determination in it. Now there's 28. There's soon going to be 30. Maybe, I don't know where the expansion's going to stop. Our ability to determine the outcome of whatever policy is designed in Brussels is now, well, technically on a mathematical basis, 3%. So Cameron's idea that if we stay in, we'll have some ability to move things the way we want them to be politically, I think is nonsensical. I don't think it can happen, and I don't think it will happen. But beyond that, it's not what we voted for. It's a federal train that's run out of control, and I don't think it was ever meant to be this way. I don't think people expected it to turn out this way, and I don't think there's any one country or any particular body outside of Brussels driving this train. It's almost just running its own course. And I think a lot of people in Europe would feel the same. Nobody in my way of thinking is anti-European or against free movement of people, but at some point you have to say, well, hang on a minute, shouldn't we just rethink what we're doing here, and maybe it's time just to call a halt? But we've tried that. I mean, Cameron went to the EU and he came back with very little. I think for most people's money, it's hard to pin him down on what he's actually achieved for us. And all I'm seeing on the Remain side is scare tactics. I don't see any positivity. All I see is warnings if we leave. Okay, they may well be right. We're going to have if we do vote to leave, I think we could suffer a pretty nasty recession. I wouldn't disagree with that. But I'm looking at it from the longer term perspective. And we owe it.
And that regaining of sovereignty.
Yeah, I think we owe it to the millions of people over 500 years of history of this country to stand up for that freedom and democracy.
I had as an American, you come to Europe. I've just been in Switzerland and France. Here we are in London, and you bring a little bit of an outsider's perspective, and I follow these things closely. But I've always kind of wondered, why is the UK the odd man out vis-a-vis Europe? And it's not animosity. I think there's people that respect each other. There's a closeness. But the one thing I do think, and this sort of came to me all at once, we were having drinks in Zurich, and the waiter brings the glass, and there was a line on the glass to show exactly the amount that you should pour. Now, a bartender will give you a small pour or a tall pour, and customers tend to go back to the place that's going to be a little more generous. Maybe you get 4 ounces of wine instead of 2 ounces of wine. But I said, look at that. There was an EU mandated line on my wine glass saying exactly how much wine should be poured in. And that's very, and that reminded me that the Europe follows what's called codification or code law, going back to the Napoleonic Code, or the Code of Justinian in the late Roman Empire. The UK is the inventor and good for it of the common law, which has room for equity. So what equity is that, okay, we know what the strict law of contract is, we know what the strict rules of evidence are, but we care about justice. And there's always a little bit of wiggle room for a judge to fade the decision one way or another to allow for equity. That's how the UK solves problems. That's how the US used to solve problems. But in Europe, it's, we have a problem, write another regulation. And if that doesn't solve the problem, write another regulation. In other words, their approach is more rules, more rules, more rules. They're not just being bloody-minded about it. It's actually the way the legal system works. So you have two incompatible legal systems, one with built-in flexibility and one that says, no, the way we solve problems is with more rules. If we haven't thought of something, we'll just write another rule. They're never going to be compatible.
Well, this is where I totally agree, and this is where I find confusion on my part, is that, the Remain side, led by David Cameron, would say, well, we're never going to take the euro, we're never going to take the Schengen Agreement, we're basically going to stay as we are outside of Europe. Well, in which case, what's the argument about? What is the argument about?
Right.
We're either in this thing properly or we're not in it at all.
Right.
And I think his side, his defence of what he's trying to achieve, it doesn't arrive at any logical conclusion to me. And I think we need to make our minds up.
And the implication is that I agree completely, Tom. And if you want to be in it properly, that means you remain and go to the euro.
Correct.
And that means a cheaper pound, cheaper sterling, even if you remain.
Yeah. And we talked about this before, didn't we?
Yeah. I know from the feedback that I've had at the Daily Reckoning that a lot of people will agree with your stance as well, Tom, which is why this is on the table and which is why we could see a leave vote come Friday morning.
I wouldn't like to call it. I would like to call it. I'd like to call it, we leave.
That was going to be my next question.
Well, it's
gun to your head. Gun to your head. Where do you think it will go?
Okay, look. This isn't a prediction, but it's a feeling that I have looking at what's happening, and it's not a premonition or anything daft like that. But I do feel there's an air of inevitability about all this. I may be entirely wrong, in which case, we'll find out next week. But looking at this chart and looking at all that's happened and looking at the way the thing has swung around in the last 2 or 3 weeks from being no chance of a Brexit to suddenly, hang on a minute, guys, actually, maybe we got this wrong. Maybe there is a chance. I feel we will vote to leave. I think we will. We'll just have to deal with whether that turns out to be a good decision or not.
As an American, I'll refrain from a prediction. This is your referendum. The only thing I would say is that if the UK votes to leave, they've got to get some gold. They just don't have enough gold. They have the resources, the people, the technology, and the economy to go it alone, but they don't have enough gold to go it alone. They're going to have to get more gold.
Yeah, well, we sold it about £150 an ounce, and now we're going to be paying $1,000 for it.
Right.
It's a good trade.
We've had some really good questions in from readers as well, guys. Jim, I'd like to start with you. We've talked a lot about what could happen if Britain leaves the EU. If we vote to stay in the EU, how do you think our relationship would evolve with the European Union? I'm thinking particularly of what you just said about the incompatible legal systems.
Right. I would expect that if the UK votes to remain, that the UK is going to have to move closer to the European way of doing things. It's the only way it's going to work. Otherwise, it's just going to be constant conflict. You'll have another referendum in 2 years. It will never be resolved. The way to resolve it, and I'm not advocating this, I'm just saying this is how I see it, is that you're going to have more and more regulation. You're going to have to move to the euro. The UK is just too important, too big an economy to be integrated with Europe and not have the euro. It just doesn't make sense. And I don't think Cameron's being, or any leading political figure is being honest with people. This is part of the global elite's hidden agenda, which is, ultimately world money and world integration. That's a topic for another day. But whether it's the IMF acting as a central bank of the world, the special drawing right, that's the IMF world money that they print. The Bank of England prints sterling, the ECB prints euros, the Fed prints dollars. Well, the IMF prints these special drawing rights. So they have world money. There's a world taxation project going on. It goes by the geeky name of BEPS, B-E-P-S, base erosion and profit shifting, led by the OECD. But you look at all these things, where there's taxation, information sharing, world money, world central bank. The elites are trying to integrate the world. Well, that you start out with little subsets of that, and then you eventually get to this world government. But getting the UK, first of all, to remain, and then secondly, getting the UK on the euro, so you make those bonds so you can never break into. 3 years ago, 4 years ago, you had Paul Krugman and Rubini and Joe Stiglitz and others running around the world with their hair on fire saying, oh, Greece is going to get kicked out and Spain should quit the euro, go back to the peseta, devalue their currency, lower the unit labor costs. There'll be a northern tier and a southern tier. And I said, nonsense. None of that is going to happen. Nobody's getting kicked out. Nobody's leaving. The euro is strong and getting stronger. They're not going to lose members. They're going to add members. Every one of those things has turned out to be true. From the time I said it, they've gone from 16 members to 19 members. Greece is still in. Spain's still in. It's a roach motel, or what we call the Hotel California. You can check in, but you can never leave. And so that's the way. That's why the elites are in full-blown panic, full flight mode about this referendum, because they don't think the UK or anyone else can ever leave. In fact, they want to go to the next step, which is to put the UK on the euro. So if the vote is to remain, I see that happening, which is why I've got sterling, and I think Tom agrees, a lower under either scenario.
Yeah, but maybe it wouldn't. It certainly wouldn't move as quickly.
Oh, absolutely. I totally agree with that. Right. And there might be a little relief rally in the short run. You've got to watch for that. That's right.
Another reader question: how do you think the result, whichever way it goes, how do you think that would affect the so-called special relationship between the US and the UK? Jim?
Well, the special relationship is under a lot of stress. Like I grew up in the Cold War, and heard my parents talk about World War II. My father fought in World War II, so the special relationship was part of my upbringing and background, and something I studied through the graduate level. But it's under a lot of stress. I think President Obama is. It's not that he's anti-UK. That's not the case. He is a globalist. I see Obama as a post-nationalist, not anti-UK, but not particularly pro-US. He's one who sees global problems, global solutions. He's always chastising Putin, saying, Vladimir, you're not playing by the rules, and so forth, as if there were rules, as if there was any sort of norms of international behavior. I don't think there are. The president thinks that there are, and he tries to hold people to it. So it's not that he's anti-UK. It's more the case that he doesn't believe in exceptionalism of America or a special relationship with the UK or anything of the kind, or even a slight vestige of empire, notwithstanding all the gifts of language and engineering and rule of law that the UK and by extension the US have offered the world, and notions of liberty, etc. He's looking at this post-national 21st century globalized world. So I do see that special relationship under some stress.
Do you think that's partly because he's a Democrat, and with the exception of Bill Clinton, the relationship tends to have been in the last sort of, since the Second World War, slightly stronger under the Republicans? Do you think there's an element of that?
Somewhat, although I would say, even though he had a short administration, John Kennedy was very much of an Anglophile. Of course, his father was ambassador to the UK in the 1940s. So I don't think it's so much to do with being a Democrat as it does with being a globalist.
Okay.
One other question here. What is involved in Currency Wars Alert? What do people get?
Well, basically, they get several updates during the course of a week. It depends entirely upon what's going on. Itemized trades, strategy, where to exit, where to enter. Well, probably where to enter first would make sense, and then exit afterwards. Managed trades, the risk profile is set, so basically all they have to do is place the trade and then place their stop once they've done that. So it basically takes out all the thought process for them. Obviously, whenever I set a trade or decide upon a strategy, I'll give a good background reasoning, both technical and fundamental, as to why that trade is being placed and where I'm looking for it to go and why. So it's pretty comprehensive.
And also, if you join right now, then you also get the special report from Tom and Jim about how to position yourself with the referendum coming up. You get a 60-day, no obligation trial period. You have time to try out the service, and for a limited time, we're also offering a very significant discount, the details of which you can get by clicking below. Next question then. Tom, would you agree that businesses in the UK have held off making important decisions because of the referendum?
There's definitely an element of that. I think in terms of R&D, sure. I mean, it would be madness to go out and splurge a load of capital investment right now in the last few months. I think that's probably been overhanging UK business for most of this year. But I think it's part of a general malaise as well. I think there's a lack of R&D in the States as well, where we've had this sort of, growthless recovery, if you like. I mean, growth everywhere is, 2% at best. So does that tells me there's a lack of investment going on anyway. I mean, part of that argument is because a lot of that investment's been done. You don't need the kind of capital intensity in terms of investment nowadays that you did 20, 30, 40 years ago. All the technology's there. So there's an element of that, but for sure, definitely in terms of hiring.
Yeah, well, I've heard that as well. I know people in the jobs market who are being told, we're not doing anything until after this.
Yeah, of course. I mean, that would make sense. It would make perfect sense.
The economists have a name for what Tom's describing. It's called regime uncertainty. And just to give an example of that, economists and scholars have studied the causes of the Great Depression, Milton Friedman and Ben Bernanke, Jan Schwartz, among others. And that's an interesting subject, but I think we have a pretty good understanding of that. What's always fascinated me is, okay, we understand the causes of the Great Depression, but why did it last so long? The United States had a serious depression in 1920. It was over in 18 months. The policy response was do nothing and balance the budget. Sounds like complete heterodoxy, but that's what the U.S. government did. That was over in 18 months. The Great Depression that started in 1929 lasted 11 years, and it took 26 years, all the way from 1929 to 1954, to regain the levels that were reached in 1929. And why was that? The answer was that business went to the sidelines. Capital went to the sidelines. There was no capital investment. President Hoover and President Roosevelt, they were just experimenting with the economy. They said, well, let's have a jobs program, and then the Supreme Court would throw it out. And let's raise the price of gold, and that got litigated, and so forth. And they would try a program. If it worked, they might do more of it. It might get shot down in court. If it didn't work, they would pull it. Fixed cotton price, on and on and on. And business just said, I'm out of here. I'm going to go to the sidelines. It was as if, we all know about labor strikes, but capital can go on strike also. And that's what happened. Capital is on strike. I see that exact same thing happening today. And I'll speak from the American perspective, but I don't think it's that different in the UK and Europe. So you're a business person. You're responsible for a $5 billion 10-year capital commitment, a plant or a new location or whatever. Well, what are your healthcare costs going to be? What are your taxes going to be? What is your environmental regulation going to be? What are the labor laws going to be? You can't give sure answers to any of those questions, and so you can't possibly project the returns, and so your tendency is to do nothing and wait till there's some clarity. That's regime uncertainty. That's affecting business investment around the world. Business investment is a big part of GDP growth. Everyone focuses on consumption, fine, that's important, aggregate demand, but investment is a big part of it as well. And right now, capital is on strike again. I think we're in a global depression, defined as not negative GDP, but GDP growth below trend. And I see that. I think the world is now Japan. The U.S., to some extent, Europe are Japan. People used to talk about the lost decade. Well, in Japan, it's 3 lost decades. Yeah. This goes back to 1989. But we're all going into this low growth, zero growth mode.
Well, I think certainly from the States' perspective, you've had, this is why I think Trump is proving to be much more popular than many people over here realize and are very surprised about. It's because he realizes and he notes in America there's a huge lack of government capital expenditure, and it's been going on for decades. Why the airports run down, why the trains run down, why is everything, electricity grid so backward, there's been no government spending there at all. I mean, the government hasn't any money, let's be honest. I don't think we've got the same problem here, but I think globally what the central banks have done is said, look, we've had this problem in 2008, everything went horribly wrong. So what we've done is we've done QE, we've slashed rates to zero, and we'll let the private sector get on with it. And the private sector's going, okay, well, that's all we're going to do. There's been no government-led directive. You name me one, apart from, say, Crossrail. Tell me something where there's huge amounts of infrastructure spending going on in the UK. They're leaving it to the private sector. And the private sector is saying, well, hang on a minute. We want some certainty here. I think the Brexit thing, understandably, is something that's going to hold back on that right now. I think perhaps once we get some clarity where we're going, where Europe's going,
Well, this brings me on to another question we've had in, which is, if the outcome of the referendum is to leave, do you see that uncertainty going away?
No, not in the short term.
Yeah, I agree with Tom. I think you just replace one uncertainty with another uncertainty. Right now, the Leave Remain vote is an uncertainty, but once that's resolved one way or the other, there's going to be a whole new set of, well, what about this? And we talked about Scotland, et cetera. So new problems will just arise, and that's why the service is so valuable, because you come out every month or every week, as the case may be, with alerts, updates, et cetera. And so it's a continuous service, not just a one-shot thing.
Well, and to be quite honest with you, if we want to make money these days, we're on our own.
Right.
We're not going to get any help from anyone else.
That's right.
So we need to take the bull by the horns in that sense, particularly when it comes to trading markets.
But you think there's uncertainty if we leave or if we stay? That both
Sure.
outcomes,
Yes.
and that presumably creates the kind of opportunities, Tom, that you are looking to take advantage of.
Volatility, uncertainty, and lack of liquidity is exactly the sort of the lifeblood of what we want to get moved.
That's what you've been doing for, 37 years now?
All my life, yeah.
Yeah.
I mean, one thing we haven't spoken about is if, again, not a political statement, but just an analytical statement, if the UK votes to leave, does Cameron's government remain? Question. If it falls, who's the new prime minister, or do you have elections sooner than later, et cetera? These are all, without taking a view, these are all important questions. If you vote to remain, then what about the European project, integration with the euro, some of the things we talked about, more regulation from Brussels to UK. So you've got uncertainty either way.
There's definitely both ways, and I think that as we said before, if we do vote to leave, and that then causes the current administration to fall, and do we get Corbyn, and do we get Corbyn combination with another Scottish referendum, and you can imagine what that's going to do to the pound. That's going to kick it so far south. We will be talking sub one.
When Corbyn first came out with the People's QE, he was widely ridiculed, and I looked at it and said, no, this is helicopter money. He had a different name for it, but People's QE is helicopter money, but establishment figures like Adair Turner from the Institute for New Economic Thinking, which is a Soros front organization and author of Between a Debt and the Devil, and a former UK regulator, very, very much of an establishment figure, has called for debt monetization. Well, debt monetization is just a fancy name for helicopter money, which is a fancy name for People's QE. So I didn't ridicule Corbyn at all. Whether I agree is a separate issue. I don't think it will do much good, but it is the coming thing.
How does that kind of policy interact with the ongoing currency war?
It's very much a part of the currency wars, because what you're trying to do above all is get inflation. You've got to get inflation. All the governments have got to get it. They cannot tolerate deflation. Deflation increases the real value of debt. That increases losses. Those losses fall back on the banks. It defers consumption, because people say, well, look, the prices are going to get cheaper. I'll just wait to buy something. It causes more savings, because people say, well, I'm not getting any yield, so I have to save more to meet my goals. And actually it destroys the tax base, because a very simple example. So let's say I make £100,000 and prices are constant. I get a 10% raise. So now I'm making £110,000. Yeah, but the government will take half of that or more in taxes. Now, a different scenario, I make £100,000, I don't get a raise, but prices drop 10%. I have the same £10,000 increase in my standard of living. Even with the same nominal income, I'm better off if prices drop. But governments haven't figured out how to tax the deflation. So if I win from deflation, I keep all of it. But if I win from inflation, the government takes half. So guess which governments favor? Governments favor inflation because they know how to tax it. So deflation destroys tax revenues. It destroys debt. It destroys banking. So government and increases the real value of the debt, sovereign debt in particular. Therefore, governments must have inflation. Now, this brings up the problem of what I call Mick Jagger, Jaggernomics, I call it in honor of Mick Jagger. The Rolling Stones had a song, you can't always get what you want. Just because central banks want inflation doesn't mean they can get it, but it does mean they're going to keep trying. And if QE has failed, if negative rates have failed, if money printing has failed, if currency wars have failed, and currency wars are continuing, they're very much active, then they're going to go to helicopter money, but helicopter money or basically larger deficits financed with government debt, and the government debt monetized by the central bank. That's what helicopter money is. It's another effort to cheapen the currency, create inflation, and so they will not rest until they get it. So that's why currency wars last so long. You know, in my book, Currency Wars, I talked about 2 prior currency wars. What I call Currency War I, which went from 1921 to 1936, ended with the tripartite accord among France, UK, and the US, and Currency War II, which went from 1967 to 1987, beginning with the sterling crisis in 67, ending with the Louvre Accord in 1987. Well, one lasted 15 years, the other lasted 20 years. This new Currency War III started in 2010. We're only 6 years into it. History says this will go on for another 10 or 15 or 20 years. So this is not the Currency Wars alert could not be more urgent, but it's also something that's not going to go away soon.
Well, surely it's exacerbated by a deflationary world as well, because you know, if you want to create inflation, as we all know, one of the few ways you can do that is to let your currency go down.
Right.
And if inflation is the lifeblood of what you really need to achieve, what you're really after, then currency was one of the few avenues left open right now to the central bankers. They don't want to come out and say it, right? They're not going to admit to anything.
Right. Now,
the interesting thing for me is sterling was to dump, you know, significantly across the board on its trade-weighted index. That's going to create some inflation, which ultimately might actually be a good thing for the UK.
So, Tom, specifically, how do you look to trade currencies within this currency wars environment?
Well,
what kind of thing are you looking for? You know, how? Just go through some of the nuts and bolts.
Subtle signs, signals that basically there's a shift. There's something going through the markets. It could be something from a subtle comment from Yellen or a Fed governor or a Bank of England governor, or some comments that lead the market to suspect, hey, there's a move on here. It could be from the Bank of Japan, you know, or from Draghi. You know, a couple of times in recent years when Draghi's made significant comments, it's been the catalyst for a major move in the euro. He hasn't been so successful lately, I might point out, but it's pretty clear in recent months that he's been trying to talk the currency down, but he's failing. He's failing miserably at the moment. So that's one area. The other area is we look at, obviously, how the economic data starts to play out and how that impacts the technical side of the trade. So, you know, I'm always looking to marry the technical aspect of the moves against the fundamentals and the white noise.
And that's how you try to get in, but you don't just look for entries and then leave people to it. You know,
of course not. We
you help people manage the trade.
We're always looking to try and reduce risk wherever possible. I'm generally speaking, I'm loath to move stops too close to prevailing market prices, but in this day and age, you simply have to, because what you don't want to do is watch a trade that's gone nicely into profit and suddenly go back and wipe you out. You don't want to have that.
And you've done that on some trades. You've locked in profits.
We have to. I mean, ideally, in the last few weeks, it's been a very difficult time, and I'd rather have not done that. But in honesty, if I hadn't have done it, we probably would have taken some hits. So, you know, it's part and parcel of the management of expectations.
But I know there's a bit in the handbook that members get that talks about what you call your 3-part trading strategy, where you can be a little bit more nuanced about how you deal with this volatility in order to get potentially more profit out of a trade.
Yeah, well, what we look at doing is, where possible, we would take, you know, a strategy where we put a trade into a block where we take 1/3 of that out, and then we take another third out of it out at various levels of profit, and then we leave the final third to run if we feel that there's a decent move coming. So that then actually improves your cost entry and allows you a little bit more flexibility, and then you can move on to the next trade. I mean, obviously, from my perspective, ideally, I'd like a portfolio of trades where I've actually got a long here, a short here, a long here, and a short here, and they're all locked in so that none of them can take a loss, and we move on to look at something else. So that's the important point about management, is that I have to manage everybody's trade for them as well as my own, because that's what I'm doing. You know, people aren't going to thank me if I just say, oh, by the way, put a trade on and let them get on with it. They expect me to manage the risk on that trade, and that's what I do.
And you put out an update at least once a week, but you've been putting out more regular
Pretty
updates
much daily
recently.
at the moment, yeah.
Can you talk us through why and the kind of thing that
Well,
you're seeing?
when things are moving, I don't want any of my subscribers to sort of say, well, you know, why hasn't he been in touch? Why hasn't he said this? Or, you know, something's going on here. I want them to feel that I want them to be aware that I'm watching things very closely and I know what's going on and I'm, you know, on top of the situation for them so that they don't feel that it's once a week update service. I think that's fine if there's nothing going on, but right now we're in extraneous times. You know, so
I know for a fact as well, because you know you send the emails to me as well just before they go out. You are very proactive about this. You are very
absolutely
keen to over-deliver rather than under-deliver and err on the side of making sure people know what's going on.
Yeah, absolutely. And I think, you know, come next week and the week after, this is gonna come to the fore even more. And it may require more than one update a day, you know, depending on what's happening. You know, because don't forget, if we have a position or a trade and it's moving rapidly, I may need to get back in touch with those guys that same day.
Tom, what kind of experience do people need if they're thinking about joining Currency Wars Alert today?
Well, very little actually. It would be helpful if they had some, which they can glean from their spread betting counterparty or by reading the handbook that we put out. But actually, you don't need any experience because I'm there to tell you exactly what to do, how to place a trade, and where to place the trade, where to get out of the trade, what the contract is, where the stop loss is, the amount you should place, based on how much resources you have at your disposal. So it's all pretty much done for you. But I mean, frankly, I would rather people have some idea and confidence in knowledge of what they're doing themselves, because I don't want anybody to feel that they're doing something that they don't really understand. But generally speaking, you don't need any experience whatsoever.
And as I say, there is a 60-day trial period, so it is possible, and I know some people do this, to see what the service is like and paper trade it on a demo account, where you're not actually putting any capital live into the market.
Sure, you may find if you don't like this, it's not for you, then you can just cancel and you know, do something else, and there's no obligation and no cost.
You know, Ben, the great thing about the 60-day window, I can't think of a better 60-day window to have. Things are so exciting right now. They're so volatile. If you're going to have a trial, what better time than right now?
But if you do want to take advantage of the substantial discount we've put together, then you do need to act now, because this is a limited time offer. When the polls close on Thursday, this offer closes, 10 p.m. Thursday, that is it. So click below, act now. Jim, for the person who's at home on the fence thinking about whether or not to take advantage of this, what kind of things should they consider?
Here's the thing, Ben. Investors, people watching us, are standing at the crossroads. There are two paths. You can subscribe to the service, protect your wealth with Tom's recommendations, or not subscribe to the service. But not subscribing is a decision. Not doing something is a decision. You're risking your wealth, your savings, your family's future by not getting the service. If you get the service, you'll be getting this excellent advice.
Tom, I'm sure you echo Jim's thoughts there. What would you say to readers who are thinking about joining Currency Wars Alert?
Well, it's straightforward to me. You can do nothing and make nothing. I view this as an opportunity. It's a cost opportunity, but I think the opportunity is once in a lifetime potentially. Over the next few weeks and months, we've got some serious moves coming, and I would seriously like to help you guys make some money.
Tom, Jim, it just remains for me to thank you for your time, for your insights, and thank you to you at home for watching. But this isn't the end. Click the link below and you'll see how Tom can help you trade this opportunity. Thank you.